Hello everybody, I'm Suze Orman. Let's talk about building wealth. It's about making smart choices. One of the smartest choices, understanding asset classes. We're going to break this down. We'll make it simple. You need to know the different ways you can invest. This is called asset allocation. It is key to growing your money. Think of it like this. You wouldn't put all your eggs in one basket, right? Same goes for your money. You need to spread it around. Don't worry, we'll go through it together. By the end of this video, you'll be an asset class pro. Asset classes are just categories of investments. Think stocks, bonds, real estate. They each have their own personality. Some are risk takers, some are slow and steady. We need to understand these personalities. Why? Because they behave differently in the market. Knowing their quirks helps us diversify. Diversification is key to a strong portfolio. It's about managing risk. When one asset class is down, another might be up. This balance keeps your portfolio growing. So, are you ready to become an investing pro? Let's dive into the world of asset classes.
Let's start with the most popular asset class, stocks. Stocks represent ownership in a company. When you buy a stock, you're buying a small piece of that company. Think of it like buying a brick in a building. Companies sell stocks to raise money. They use this money to grow their business. If the company does well, its stock price goes up. You make money by selling your stock at a higher price. But just like any investment, stocks come with risks. The stock market can be volatile. Prices go up and down, sometimes dramatically. Remember the brick in our building analogy? What if something happens to the building and its value drops? The same can happen to stock prices. Company performance, economic conditions, even global events can impact stock prices. This is why diversification is so important. Don't put all your eggs in one stock or one sector. Spread your investments across different companies and industries. Section 3. Potential returns and long-term growth. Despite the risks, stocks have the potential for high returns. Historically, stocks have outperformed other asset classes over the long term. This is because when you invest in stocks, you're investing in the growth of the economy. As companies grow and innovate, so does the stock market. However, remember that stock market investments are best suited for long-term goals. Don't invest money you need in the short term. Ride out the market fluctuations. Stay invested for the long haul. Over time, the power of compounding can work its magic on your investments.
Now, let's move on to another important asset class, bonds. Bonds are different from stocks. They are like loans you give to governments or companies. When you buy a bond, you're lending money for a fixed period. In return, you get regular interest payments. This is called a coupon payment. At the end of the bond's term, you get your principal back. This is called maturity. Bonds are considered less risky than stocks. Why? Because you're promised a fixed return. You know how much interest you're getting and when you'll get your principal back. But remember, lower risk usually means lower returns. Bonds generally offer lower returns than stocks. This is the trade-off. Think of it like a seesaw. Stocks are on the high-risk, high-return side. Bonds are on the low-risk, low-return side. The key is to find the right balance for you. Your risk tolerance depends on your age, financial goals, and how comfortable you are with market fluctuations. If you're younger and have a longer time horizon, you can afford to take more risk. As you get closer to retirement, you might want to shift towards lower-risk investments like bonds. Section 3. Bonds and diversification, a balancing act. Bonds play a crucial role in diversification. They can help cushion your portfolio during stock market downturns. When stock prices fall, bond prices often rise. This is because investors tend to seek safety in bonds during times of uncertainty. By having a mix of stocks and bonds, you can smooth out the ups and downs of the market. This is what diversification is all about. Remember, there's no one-size-fits-all approach to investing. Your asset allocation should be tailored to your individual needs and goals.
Section 1. Understanding cash and cash equivalents. Let's talk about safety. Cash and cash equivalents are the safest place for your money. Think of them as your emergency fund. They are your financial cushion. This category includes your savings accounts. It also includes money market funds and treasury bills. These are short-term government securities. The great thing about cash and cash equivalents is liquidity. You can access your money quickly. You need cash for unexpected expenses, but here's the trade-off. Cash and cash equivalents offer the lowest returns. You won't see your money grow much in these accounts. The role of cash in a diversified portfolio. Why hold cash at all? Cash provides stability, it balances out risks. Think of it like this: your portfolio is a car, stocks and bonds are the engine, cash is the brake, it helps you slow down. You need brakes too. Cash acts as a cushion, it plays a vital role, it helps you stay invested, it gives you peace of mind.
Exploring real estate more than just bricks and mortar. Let's talk about real estate. It's an asset class that's familiar. We all understand the concept of owning a home, but real estate investing goes beyond your primary residence. It includes residential properties like rental homes. It also includes commercial properties like office buildings and shopping centers. Real estate can provide a steady stream of income. Think rent payments from tenants. And as property values increase, you can gain from capital appreciation. Real estate also acts as a hedge against inflation. As prices rise, so do rental income and property values. This can protect your investment from losing value. Now, there are two main ways to invest in real estate: direct and indirect. Direct investing involves buying and managing properties yourself. This gives you more control but requires time, effort, and expertise. You're responsible for finding tenants, collecting rent, and maintaining the property. Indirect investing offers a more hands-off approach. You invest in real estate through REITs or real estate investment trusts. REITs are companies that own and manage income-producing real estate properties. They allow you to invest in real estate without the hassle of property management. REITs are like stocks. They trade on stock exchanges, making them easily accessible. You can buy and sell REITs just like any other stock. REITs are required to distribute a significant portion of their income to shareholders as dividends. This makes REITs an attractive option for income-seeking investors. REITs offer diversification within the real estate sector. They invest in various property types, such as apartments, office buildings, and shopping malls. By investing in REITs, you can participate in the real estate market without the large capital outlay required for direct property ownership.
Let's move on to commodities. These are the raw materials of our economy. We're talking about things like oil, gold, and agricultural products. These are the things we use every day. Think about the gas in your car, that's a commodity. The wheat in your bread, that's a commodity too. Commodity prices can be volatile. They're influenced by supply and demand. Think about oil. If there's a disruption in oil production, prices can spike. On the other hand, if there's a surplus of wheat, prices may fall. This volatility is what makes commodities both risky and potentially rewarding. Investing in commodities is different from stocks or bonds. You're not buying a piece of a company or lending money. You're investing in the raw materials themselves. You can invest in commodities directly by trading futures contracts. These contracts allow you to buy or sell a specific commodity at a predetermined price and date in the future. But futures trading can be complex and risky. It's not suitable for all investors. Another way to invest in commodities is through ETFs or exchange-traded funds. ETFs hold a basket of commodities. They offer a more diversified way to invest in the commodity market. So why consider commodities for your portfolio? Commodities can act as a hedge against inflation. When inflation rises, the prices of goods and services tend to go up. This includes the prices of commodities. By investing in commodities, you can potentially protect your portfolio from the eroding effects of inflation. However, it's important to remember that commodity prices can be volatile. They are influenced by a variety of factors, including global demand, weather patterns, and geopolitical events. It's essential to carefully consider your risk tolerance and investment goals before adding commodities to your portfolio.
Section 1, Alternative Investments, Exploring Beyond Traditional Assets. Let's step off the beaten path. Let's explore alternative investments. These are investments that are different. They are not your typical stocks, bonds, or real estate. Alternative investments include things like hedge funds, private equity, and venture capital. These investments can be complex. They often involve higher risks, but they also have the potential for high returns. Alternative investments are not for everyone. They are typically reserved for more sophisticated investors. These investors have a high risk tolerance. They have a long-term investment horizon. They understand the complexities of these investments. Section 2, Navigating the World of Hedge Funds. Let's start with hedge funds. These are investment funds that use advanced strategies to generate returns. They can buy and sell a wide range of assets. Hedge funds can use leverage. This means they borrow money to amplify their returns. This can be risky, but it can also lead to significant profits. Hedge funds are typically only available to accredited investors. These are investors who meet certain income or net worth requirements. Hedge funds also charge high fees. These fees can eat into your returns. It's important to carefully consider the risks and fees before investing. Section 3, Private Equity and Venture Capital, High Risk, High Reward. Let's talk about private equity and venture capital. These are alternative investments in private companies. Private equity targets mature companies. These companies may expand or restructure. Venture capital focuses on startups. Startups often develop new technologies. Both can be very risky and illiquid, but they offer high return potential. Successful investments can yield astronomical returns.
Let's dive into the world of cryptocurrencies. It's a new frontier in investing. Cryptocurrencies are digital currencies. They use cryptography for security. Think of Bitcoin. It's like digital gold. But instead of being stored in a vault, it's stored on a blockchain. A blockchain is a decentralized ledger. Cryptocurrencies operate independently of central banks. This decentralization is appealing to some investors. They see it as a way to avoid government control. Cryptocurrency transactions are recorded on the blockchain. This makes them transparent and secure, but it's important to remember that cryptocurrencies are still in their infancy. Understanding the volatility of cryptocurrencies. Cryptocurrencies are known for their volatility. Their prices can fluctuate wildly. This is because the market is still relatively small. It's also driven by speculation. News and sentiment can have a big impact on prices. This volatility makes cryptocurrencies a high-risk investment. It's important to only invest what you can afford to lose. You should never invest in cryptocurrencies with money you need for short-term goals. Despite the risks, cryptocurrencies have the potential for high returns. Some investors believe they are the future of finance. Cryptocurrencies and portfolio diversification, a cautious approach. So, should you add cryptocurrencies to your portfolio? It depends on your risk tolerance. If you're comfortable with high volatility, you might consider a small allocation. But remember, cryptocurrencies are still a speculative investment. There's no guarantee they will succeed in the long term. If you're considering investing in cryptocurrencies, it's crucial to do your research. Understand the risks involved. Start with a small investment. It's also important to choose a reputable cryptocurrency exchange, and make sure you store your cryptocurrencies securely. Remember, diversification is key. Don't put all your eggs in one basket, especially when it comes to cryptocurrencies.
The power of diversification, a recap. There you have it. We've journeyed through the world of asset classes. Remember those eggs? Don't put them all in one basket. Spread your investments. That's diversification. We talked about stocks. They offer potential for growth, but they come with risks. We explored bonds. They provide stability, but their returns are generally lower. Cash, it's your safety net. Real estate, it offers income and inflation protection. Commodities, they can hedge against rising prices. Alternative investments, higher risks, but potentially higher rewards. And cryptocurrencies, a new frontier with high volatility. Your journey to financial well-being? There's no one-size-fits-all approach to investing. Your ideal asset allocation depends on you, your age, goals, and risk tolerance. Understand your financial goals, saving for retirement, a house, your child's education. Determine your time horizon, how long to invest, more time, more risk. Consider your risk tolerance, comfortable with market fluctuations, easily spooked. Choose a conservative portfolio. Investing can seem complicated. Start small, keep learning. The most important investment is in yourself.